Have you ever considered that every dollar you deposit in the bank may actually be losing value over time? Many people look at today's 4% to 5% short-term interest rates and feel a sense of security. Some even plan to rely on that interest income for retirement. But the reality is, this sense of comfort can be misleading and even dangerous. History has shown us time and time again that periods of high interest rates are short-lived. Today, let's take a closer look at interest rate trends, and more importantly, how informed investors are positioning themselves in a declining rate environment. In particular, we'll discuss how multi-year guaranteed annuities, or MYGAs, are being used to lock in rates around 5.5% while also benefiting from tax-deferred growth. If we examine historical rate cycles, a clear pattern emerges. Over the past several decades, we've seen 4 major rate hiking cycles, each followed by a significant decline in average rates over the next 5 years. In 1995, rates peaked at 6% with a 5-year average of about 5.38%. Then, in 2000, rates climbed even higher, reaching 6.5%. However, the following 5-year average dropped sharply to 2.85%, a decline of more than 50%. A similar pattern occurred in 2006 when rates peaked to 5.25% and were again cut roughly in half in the years that followed. In 2018, rates modestly rose to 2.5%, only to fall to an average about 1.2% over the next several years. The takeaway is simple. High interest rates are not the norm, they're temporary peaks, and once rates reach those peaks, they tend to decline, often significantly. Most recently, in response to post-pandemic inflation, we experienced one of the fastest rate hiking cycles in history. Beginning in March 2022, the Federal Reserve raised rates 11 times in over a year, bringing them to a peak of 5.5%. Since then, rates have begun to decline, falling to around 3.75% by early 2026. Based on historical patterns, these downward trends may continue. For those who are waiting in the sidelines, this may represent a narrowing window of opportunities to lock in higher rates. At this point, many people ask, why not just use bank CDs? And while bank CDs can be appropriate in certain situations, there are 3 important limitations to consider. First, CDs typically do not allow you to lock in long-term rates. Most terms are relatively short, 3 months, 6 months, or even a year. Even 2-year terms often come with lower rates. When those CDs mature, if interest rates have declined, you're forced to reinvest at a lower yield. Second, there is the issue of taxation. Interest earned from bank CDs is taxed annually, regardless of whether you withdraw from it. For example, a 5% return may be reduced to 3.5% after taxes, and a 4% return may come closer to 2.8%. In today's environment, actual after-tax returns can be even lower. Third, inflation must be considered. After accounting for taxes and inflation, your real purchasing power may not increase at all, and in some cases, it may decline. This is why many high net worth individuals are turning to MYGAs, multi-year guaranteed annuities. In today's market, MYGAs commonly offer terms of 5, 7, or even 10 years, with rates still around 5.5%. They provide 2 key advantages. First, they allow you to lock in a fixed rate. Regardless of whether the interests go up or down in the future, you continue earning that fixed rate during the duration of the contract. Second, they offer tax-deferred growth. Unlike CDs where interest is taxed annually, MYGA earnings are not taxed until withdrawn. This allows your money to compound more efficiently over time, as funds that would have gone towards taxes remain invested and continue to grow. Some investors may feel comfortable staying in short-term CDs because current rates are still relatively attractive. However, it is important to remember that these rates are not guaranteed to last. Historically, once rate cuts begin, CD yields tend to decline quickly. For example, if you were to invest in a 1-year CD today, there is a strong possibility that when it matures, the available rates will be significantly lower, potentially closer to 2%. One of the greatest risks in financial planning is reacting too late. If you currently have $100K, $500K, or even more in idle funds, and you're looking for a solution that offers both stability and protection against a declining rate environment, a MYGA may be worth serious consideration. Of course, every individual's financial situation is unique. Evaluating options, comparing providers, and understanding tax implications should all be part of a thoughtful decision-making process. But one thing is clear: opportunities like this do not last indefinitely. Waiting too long may mean missing the chance to secure today's higher rates. Thank you for your time, and if you found this helpful, feel free to like and subscribe. See you in the next one. Bye!